Well, yesterday we saw the Reserve Bank raise the cash rate by 0.5%. That was a bit more than the market was expecting. We're expecting 0.4%, and we were the only major that has been consistently arguing that you needed to have a larger rate hike than the 0.25, which the Reserve Bank described as business as usual on the 2nd of May. And we think there's more to come. We think that the Reserve Bank will now have to do another 50 basis points in July, and all that will do will bring the cash rate to 1.35%. Remember, in 2019, the cash rate was cut from 1.5 to 0.75, and that was because inflation was ridiculously low and the Reserve Bank was getting frustrated and they need to cut rates. Now, of course, with inflation in the other direction, those rate cuts need to be reversed as well. By July, the cash rate will be at 1.35. We expect another hike in August to get the cash rate to 1.6. And then remember that 1.6 is around where I would call neutral. So when you go above 1.6, you're moving into what I would call contractionary territory, and therefore you can be a bit more cautious. So I expect a pause in September and October, but when we see another big inflation report in late October, they'll have to respond again in November and December, and once again in February. And at 2.35%, we see that as the peak in the cycle. That, of course, will be driven by a substantial slowdown in the economy, particularly in the December quarter, as the reopening effect and the benefit from Australia's high savings rate coming down and releasing spending, that starts to fade. And in 2023, that will be a very weak year for growth, only around about 2%. But I think the advantage of that is that the Reserve Bank won't need to go heavily into contractionary territory where it could do a lot more damage to the economy.